We have to discuss why investors on average significantly underperform a market index and how to avoid this. I have worked in wealth management for well over 15 years here in Switzerland, and the statistic I'm going to show you never ceases to shock me. We have established in previous videos that investing is a crucial skill to build out your wealth. Just saving will not be enough. You have to beat inflation and beyond. So what I'm going to talk about today is one of the most important skills you will ever learn to build out your wealth. You can watch all the YouTube videos, listen to all the podcasts, and read all the books about money and investing, learn all the money techniques. But if you don't master this, you will end up underperforming the market like most investors and missing out on massive amounts of wealth. So here it is. I will leave a link in the description below. The graph shows average returns for different asset classes, like real estate, equity, bonds, and compares it to what the average investor makes. So the S&P 500, for example, that you can see here, returned 8.2% per year during the 20-year period where the study was made. A bit lower, but close to its long-term return of around 10%. Nowadays, you can simply buy a low-cost index fund that gives you these type of returns. But yet, the investor on average achieve only 2.1% on their money, over here at the end of the scale, not even beating inflation. This is a massive difference. Let me remind you that the difference between making 2 or 8% on your money over a lifetime amounts to hundreds of thousands, if not millions of dollars later in life. Now, why is this? Why does the average investor fail so miserably in this day and age where all you have to do, I'm going to do this in brackets, all you have to do is buy a low-cost index fund that tracks the market, right? Everyone spreads this message. It's so easy, just buy a low-cost index fund. Well, the thing is, yes, it's simple, right? But it's not easy, like with most things. It all boils down to handling difficult emotions experienced during a market crash, like fear, stress, pain. And the reasons why investors end up with the returns shown on the graph is because they can't take these emotions. And they panic sell, and they sell at the worst possible moment, right? When the market has crashed 30, 40, 50%. And after that, try and time the market to get back in and miss out on the biggest returns that happen on the rebound when the market starts recovering. So I've worked in wealth management for well over 15 years, as I mentioned, and I was there in the global financial crisis. It was an absolute terrible time. I've seen it all in the portfolios of clients. I've seen Lehman Brothers, Madoff. I've seen all these Icelandic banks that went bankrupt. And people were absolutely devastated, understandably, but also those with more simple portfolio structures. My main job was actually just talk to clients. You can imagine, like a support hotline from 7 a.m. to 11 in the evening, and just trying to calm people down. But still, people sold, and understandably, the market can be brutal. The market is humiliating, and it triggers a fight or flight response that is deeply ingrained in our DNA, that is ingrained in our primordial brain. And so it's a trigger of evolution. It's the same as encountering a tiger out in the woods. I hope there's none here. No, there is none. And everyone has their trigger points. Some panic at 30% crash, 40, 50% crash. Many people after 50 just panic. And so to overcome this, we need to work on our behavior. And we need to build what I like to call financial toughness. Now, before we continue, I want to welcome all old and new viewers to this channel. And a special thanks to everyone who's already subscribed. Thank you very much. That means a lot to me. Consider subscribing as well if you haven't done so. That will help tremendously. And otherwise, leave a comment down below. Tell me where you're from. Share your thoughts. But yeah, also tell me where you're from. I love to hear where my viewers sit in the world. So thank you very much. So financial toughness. So what it is not. Being financially tough is not being fearless. Removing fear entirely is, I don't know anybody, and I don't know anybody that knows anybody that is completely fearless. I think a bit of fear can also help us to move forward and propels us forward. And it's also not bragging about the great trades one has made and where one has made lots of money. That's a bit of a sign of immaturity. So what it is, being financially tough, is the ability, despite fear, to endure stress, pain, and to endure hardship mentally and physically. So, and I say physically because I've seen or heard about people throwing up, or also being sleep deprived, which, is a difficult situation to be in. So that's what financial toughness is. It's a bit like an athlete that maybe despite an injury keeps pushing forward to complete a marathon. So how do we avoid this behavior? And how do we improve our financial toughness? It all boils down to practice. I'll give you a few things. So thing number one is being aware of this. Now that you've watched this video, and even if you already knew this, you are reminded of this, right? Being aware that your brain can hijack you in these situations, you have already a massive advantage. The second one, practice. Now you have to practice. This is like going to the gym. Expose yourself to these market fluctuations. Start small. Start with maybe not so much money the first year or two, depending on how comfortable you feel. And the way to practice is using the market. So the market gives us, on average, once a year, a correction around 13, 14%. Okay, it's not a full-on market crash. It usually lasts around 2 months on average. These are all average statistics. And so if you use that once a year, as you're aware of these market corrections and already 10, 15% down on your portfolio, it is something not to be scoffed at. So use this to build up your toughness. Now, the other thing you can use to build up your financial toughness is knowledge, right? And if you're a passive investor, you can use it the following way. So the Dow Jones has risen from 66 to 40,000 over its lifetime. And this despite world wars, despite pandemics, despite financial meltdowns like 29 and 07, 08, and it has risen this far. And if you're an active investor, know what you're holding. You should anyway know what you're holding, but now it will become even more important when you're going through a crash. Know exactly what you're holding, have your thesis ready. You know that the company can survive a crash. Well, you can never know for sure. That's why you diversify, but you have a high level of confidence. And also break out of your echo chamber, have your thesis on your investment challenged, and then stick to it. The fourth thing you can do is don't always look at your portfolio during a crash. This is super difficult to do. But if you do, don't do it when you're either tired or drunk. Like, that's the worst thing you can do, right? 11 p.m. on the terrace, a few bottles of wine, I don't know, but a few glasses of wine, and yeah, you look at your portfolio, you see your life savings melting down. That's it. Then the other thing I would also recommend, work with a financial advisor or with a mental coach, somebody that is battle hardened, that has been there. As I mentioned before, I was like the hotline to my clients many times. I must say, one thing where I have added value is really not making people sell. And I'm very proud of that. Yet another thing you can do is change your perspective. Embrace the market crash. Embrace it as an opportunity to massively increase your wealth. Market crashes can leapfrog your wealth. They have done for me, and it takes a while to get you there to really buy when the world seems to be going down. If you can manage to do this, I guarantee you your wealth will catapult. And another way to see this is, even if, let's assume that all the bad news when market crashes are happening, that the world's going down, the capitalistic system is no more, you will probably have other worries than your investments. So might as well just stay invested, right? Yes, okay, good to have an emergency fund for more conservative investors, have some gold and silver if that gives you some peace of mind. But what's the point in if everything's really coming down and the capitalistic system is coming down? again, you probably have other worries than your investments. And here's a bonus one to finish off. Exercise, or go for a walk, or sit out in nature, whatever calms you down, meditate, whatever it is, right? That really also helps you to keep your emotions more under control, right? So if you exercise and if you do that, you know how you feel after, usually more relaxed and more contained. And that's the feeling you want to have, strong, mentally strong during a full-on market crash. All right, I'm going to stop here. There would be a bit more to be said, but I think you have enough, more than enough, to become a better investor, to improve your financial toughness. If you liked the video, please leave a like, and I'll see you in the next one. Thank you very much for watching, and take it easy.